So it was in the middle of the financial crisis that I realized that I get these monthly statements from the different banks or my pension fund. Usually I open them, look at them, file them, and then I realized that several months have passed and the pile has gone up, and I basically avoid looking at those envelopes.
In the middle of the crash.
In the middle of the crash. So for 6-7 months, I don't open any envelope that comes from any financial institution. So I called George Lowenstein, who is my colleague and friend and an expert on behavioral economics, and I asked him, am I crazy? He says, no, you're an ostrich, you know. So I said, anybody studied it? He says, people studied, but you know, there is a room to study more. Do you want to do something? I said, okay, let's study ostriches. But there is a literature not only in economics or in finance, but in other fields like medicine and et cetera, that people ask a general question, what makes people pay attention to information or obtain information? So the issue of paying attention to information has been studied before. It's a current topic of research. And what we apply it here is to investors paying attention to their portfolio. And more specifically for this specific study, we are looking at investors who the way they pay attention to their portfolio is by going online and check their balance. We cannot see whether people behave like me, whether they open the envelope or don't open the envelope. So the only information we can have as far as paying attention is actually look at their online behavior. I have 2 slides that we are in the middle of writing a very big dynamic model. So just to give you the intuition behind the empirical work, so you'll see what we are after. So we are focusing on information-dependent utility. So this is a deviation from the standard economic or finance model because it's focusing on psychology. So the utility is from the information itself and not from the implication for consumption or investment. So it's completely psychological. And the idea is that people derive pleasures and pain just from seeing what happens to their portfolio. So every day I pass by the board on Uris Hall when I go home and I see what happened to the market. And the question is, why do I even bother to look? Because I haven't touched my pension fund for the last 20 years, and I should have maybe. So, but people do acknowledge that they do derive pleasures and pains from seeing what happens to their portfolio. So that's the idea of this paper. Now, what we assume that if you don't check, you just go home and look at the TV, you know what happened to the market. And what happened to the market is a signal to what happened to your own portfolio. Not a perfect signal, depends how much your portfolio is correlated with the market. But it does provide you a signal. So we assume that this you see every trading day. But what you don't do, and you have to decide, so the only decision that you have to make is whether at that day, at the end of the day, to go and check your account and see actually what happened. Now, we assume that the pleasure or the pain that you derive has to do with what you see or what the signal gave you relative to some benchmark. So this is the pain and pleasure from seeing increases and decreases in your wealth or perceived wealth. The benchmark is updated, so it's basically what you see relative to something that happened in the past. But what happens when you check your balance, not only that you see now for certain what you have, but also your benchmark is updated. So now you know for sure what you have, and from future pleasures and pains will be related to this what you have seen. And what investors are doing are trying to maximize some kind of a net present value of all these pleasures and pains. So they monitor it by deciding if and when to look at their portfolio. So this is the story behind this model. Now, this model gives rise to an ostrich-like behavior under quite general settings. So basically, and what's the idea? The idea is that when the market goes down, you behave like me, you don't want to see because you better not look. When the market goes up, you can go and enjoy the pleasure of seeing something good that happened to your account. So the way we defined ostrich behavior is the tendency of investors to avoid paying attention to their account when the market goes down. So how do we check it? We have a very large data set, over 1 million investors of Vanguard accounts. These are all 401 401k accounts, so these are pension funds. To avoid people, since we cannot see when people open or close the envelopes, we limit our study to people who have paperless accounts. So the only way they can see what happened to their account is go online, so they don't get paper account. And we have daily information about both whether they log or not, go online or not, and also when they trade for right now for 2007, 2008, which is good 2 years because we have 1 year before the financial crisis. We have the financial crisis, so you can see some differences between these 2 years. On top of that, I have monthly data on their balances, the division between equities and non-equities, and I also have some demographics. Just briefly, basically, this is the full sample of over 1 million people. The paperless accounts, they are a little bit different. The paperless accounts are younger, more male. They have more money, they have more equity, but the differences are not that big, so it's not such a big bias to study paperless accounts versus the general population of these 401k accounts. First observation is that a lot of people don't look at all during this 2 years period. So almost 3% of those investors never go online to check their account at all. And then you see that it's decreasing completely monotonically. So this is what you have here is like the 2 years, 700 and something days. And so these are the people who don't look at all and decline monotonically. So the distribution of how many times people look is declining monotonically with a number of days. Few statistics, there is a very strong day of the week effect. I have no idea. By the way, before I had this Vanguard data, I got another data set from a bank in Pittsburgh. And I once thought that I made a mistake because I did the same graph for the bank in Pittsburgh, and it is identical. So somehow this day of the week effect is identical. Just to give you some idea about the numbers, so the median number of logins in our data over the 2 years periods is 36 days. So 36 times during the 2 years period people look, and you see that the median number of times that they trade is 1, or the means are 85 and 2. So there is very little trading going on in these accounts. So the bad news is that if you want to study trading, there is not much to study in this data set. But the good news is that this table basically shows that people pay a lot of attention that has nothing to do with trade. So if you want to study attention, and people did try in the past to study attention by looking at trades, this is not the right place. This basically shows you that there is a lot of attention and not attention that has nothing to do with trades. There is some correlation between the number of days, number of times you trade and number of times you look, but it's not that impressive. So there is not strong correlation between the number of times that people trade during the 2 years period and the number of times that they look at their accounts. These are few, I will go very briefly. These are simply some correlation between the frequency of looking and some other demographics like age. I look here when they have larger balances, it's increasing the number of times. Also trade increases a little bit. This has been found also in other studies that men are trading more than women. So this has been showed before. These are because I have a lot of people that I don't know their sex, so it's not a third sex. It's just men looking more than women, trading more than women, and also we find in our data that men also go online more frequently than women. So now this is just basic statistics, some more about the actual ostrich effect. So the top line just show you the Dow Jones over the 2 years, 2007, 2008. The brown line is the number of times. So each observation here is a day. So we're looking, the unit of observation is a day. So at any given day, we look at the number of times, the number of people that went online. And here, the number of people that traded, it's scaled a little bit. So the scales are just adjusted so we can see it at one graph. So there are two things that you will see if you spend a few minutes looking at this graph, at this specific graph. One is the first confirmation to the ostrich effect. When the market goes down, people look less. When the market goes up, people look more. That's one thing that you can see. The other thing that you can see is that when there is a huge change in the market, like the financial crisis, these things break down. People just look more, regardless of whether the market goes up or goes down. So one of the things that we see in this data is that this co-movement of the market and logins happens a lot, but when things are going completely out of line, like crazy changes in the market, you see increase in logins, regardless of whether it's positive or negative change. So this is a regression where for any given day, so this is the number of observations in number of days. For any given day, we look at the number of people that go online, and we have a dummy whether the market went up or down. And so this is one of the main findings of this paper, that following a day that the market went down, the number of people that go online is almost 9% less. So this is like, if you want to ask what is the ostrich effect, when the market goes down, almost 9% less logins than when the market goes up. Okay? So, and these are just looking at different time periods over the last week, over the last month, but basically the observation is more or less the same. It's interesting when you look at 2007, 2008, it's much stronger in 2007 than 2008, because what happens in 2008, you see the opposite. When the market drops down, there is a huge increase in the number of people that go online, and that's why it mitigates this coefficient, and it's almost half than what it is in 2007. And then the next step, that instead of looking at dummy variable, market goes up, market goes down, we start looking at the actual percentage change in the market, and how the actual change in the market, and how people react in terms of logging in. So this table just shows that the bigger the change, the more people look, the smaller the change, they look less. And then we try to allow for all kinds of nonlinearities, so we don't have time to analyze all these nonlinearities, but basically you can see that if you play with different polynomial equations, you get all kinds of different results. But maybe the graph here summarizes everything. This is like using like numerous regressions from, I don't know if you're familiar with these graphical techniques. You basically run regressions, many, hundreds of regressions on small ranges, and you connect the lines, you create the line. So this is the zero change. So basically you see when the market changes, so this is the percentage change in the market on any given day. When the percentage of change is positive, there is not much going on. So the main ostrich effect is happening here within this range. And then we stopped here the line because it's misleading. But if you'll do run the line, you'll see that it's going up on the left and up on the right. And sometimes we used to call it the mustache effect because it goes up on the sides. But when we decided to submit it to a journal, we decided that this mustache effect is really artifact of like 2-3 points that are on the extreme. Look here, this is 10% daily change in the market, and this is 10% drop in one day. And there were like crazy days like that. You can see it here, and you can see it here. So this is the main description of the ostrich effect, that the market, basically when the market goes down, the number of logins is decreasing. So the next question was, okay, how many guys like that? So we decided to look at each individual investor and try to study how they behave. So what we did, and the second question, which is very interesting from psychological point of view, do people who behave as ostriches in one period also behave as ostriches in another period? So is this a psychological trait that is persistent over time? Then the next question that we wanted to answer is almost like a placebo effect. So the reason why you react as an ostrich, because you go down and look at the board and see that the market went down and say, I don't want to look. I don't want, not only that I see the bad news on them, I don't only to enhance this bad news by going home and checking. But this should not be the same for people who know that they have no equities in their account. So my initial reaction was, let's look as a placebo effect to look at people who have no equity whatsoever and see if they behave like ostriches. Hopefully not, but maybe they behave like that because they had equity before and it's just whatever. And then talking to my colleagues in the finance division, they said, maybe you should see the opposite, because the market, these people, for these people, it's the opposite. So maybe when the market goes down, it's even good for them as far as their own portfolio that has no equity in absolute terms or relative terms. So everybody's stock went down today. Let me go and see that nothing happened to mine. It's just good news. And then if we can characterize and see what other characteristics they have to these ostriches. So in order to do that, basically we ran 100,000 regressions. So on each investor, we run a regression on every day for these about 700 and something days during the 2 years period. And we have a dummy for whether the market went down or up. So basically, if the dummy is negative, then the person behaves like an ostrich. If it's positive, it's the other way around. So here is the result. When we look at the whole 100,000, it's almost 50-50, although it's still difference. But more people behave like ostriches than non-ostriches. But then, these coefficients can be significant or insignificant. So we said, let's see only on confirmed ostriches versus confirmed non-ostriches. So when we limit the sample to only people for whom this coefficient is significant, you see a big drop. And the big drop is because you have a substantial number of people that have either no logins at all or very few logins. So you cannot get a strong coefficient. And now you see that it's 80-20. So basically, if you look at the investor for which you can confirm either ostrich or non-ostrich behavior using this regression, from this subsample, 80% behave like ostriches, 20% behave like non-ostriches. This is about the persistence over time. So for each investor, we ran 2 regressions, the same regression for 2007 only and the regression for 2008. So we have now 2 coefficients. One shows their tendency to be ostriches in 2007. The other shows it's in 2008. And this is the correlation between the two. This is the correlation of all of them. This is the correlation when you look only on significant coefficients. And the correlation is quite significant and positive and significant. So this graph basically confirmed the hypothesis that people who exhibit ostrich-like behavior in 1 year, they also exhibit it in the other years. So it confirms the hypothesis that it is a persistent trait. Now, coming back to ask about about people who don't have equity, so we went and this way we didn't want to go on the 100,000 sample because there were not enough observations, so we went to the larger sample of over 1 million investors, and we did the same thing only on people who have no equities whatsoever in their account during the 2007-2008 period, which they might have had equities before, but at least during this window, they don't hold any equities. And here, things are flipping, especially if you look at the coefficients here, they behave the opposite. 67% of them behave like anti-ostriches, and 32%, 33% behave like ostriches. So things are flipping when you look at people who have no equity in their account. This is basically the last one before we finish. This is just regression that basically the dependent variable is the level of ostrichness, and the independent variables are different characteristics. So you can see if you look at the last column, they are older, the ostriches, more male than female. They have more equity, and they have higher wealth. Their balance is higher. So just to summarize, this is quite a new way, this study, to measure attention is by looking at log-in behavior. We find that there is a big asymmetric behavior following in their log-ins following market increase or market decrease. As I said, the general finding is that 1% decline causes, it shouldn't be 1%. A market decline on average costs 8.7 less log-ins. You see some nonlinearity, and especially you see on the extreme, you see a big increase in log-ins regardless of whether it's up or down. So we think that there are other, of course, during these times when there is a very big change in the market, there are other things that cause people to log on that are outside of our model. we find that there are more ostriches than anti-ostriches. And as I summarized in the last graph, they are more likely to be men with large account balances, longer tenure, and higher equity exposure. I think, and the broader interpretation of our study is that it does support the hypothesis that people pay attention for psychological reasons, not only in order to decide what to do with their assets. That's it. Thank you.